Hey, everybody. Thanks so much for joining us today for our spring market commentary call. We've got Christian Bryant, the Chief Investment Officer at Nold Bryant, and we've got Steve Colano, the Chief Investment Officer at our partners at Integrated. I know maybe the market's not quite as exciting as it was when we initially came out with this call. Hopefully, knock on wood, it stays that way for a while. But I'm going to go ahead and turn it over to Christian to get started. Christian, are you going to give him the process for asking questions and all that as well?
Yeah, that'd be great. Yeah, thank you all again for joining. We were just joking offline. I went back and looked to see when we set this call up, and it was actually April 2nd, which, if that date doesn't ring a bell for you, that was Liberation Day. So a lot's happened since then. We'll see if we get the same level of turnout we would have gotten about a month ago. But yeah, so if you want to ask questions throughout it, we're going to get through a bunch of slides here. But feel free to drop them in the chat. We think we've set it up so that only the host will see those questions. So feel free to ask whatever you want, and we will stop and answer those along the way. So yeah, we have with us Steve Colano. If you've been on one of these calls before, you've gotten to hear him talk. But he's the Chief Investment Officer for Integrated Partners. They've got over 20 billion under management. Steve has a career in institutional asset management. So before he integrated, he was at BNY Mellon. He's been at JP Morgan. He's definitely the smartest person on this call, at least of the hosts. Maybe some of you
I don't know about
smarter
that.
than him, but so anyways, we'll turn over to him, and then we'll stop along the way and talk about various things. So Steve, the floor is yours.
Awesome. Thanks, Christian. Yeah, in the spirit of misery loves company, and wondering what the attendance would be now that markets have recovered and like we're all good. We don't need to worry about anything. So I am gonna share my screen and we can get off. I'm still not used to getting invited back to any place, so I'm super happy to just be back. And I appreciate everyone's time. I know I'm gonna make this bigger. I appreciate everyone's time because I know it's a busy time of year for people as the summer is quickly approaching, and hopefully summer vacation plans are in the way. But yeah, as Christian mentioned, I think Drew was just talking. Like, I think I did an economic outlook for a group of clients about 3 weeks ago, and literally this is the slide I would have shown 3 weeks ago, and I figured it fitting to start today because it's amazing how quickly things change in the markets. Christian and I were talking before, like if there was ever a poster period for you can't time the markets, I think those last couple of weeks have been it, because this is just from a couple of weeks ago. This is as of April 14th, so just a week and a half past quote unquote Liberation Day. At that point in time, significant concerns around an accelerating trade war. I think tariffs on China at that point were 145%. And 125% back at us, and negotiations hadn't started yet. And at one point, the market was down. The S&P 500 anyway, which is this is the chart of the S&P 500 down almost 19%. And I think there was even a day in there where we did cross through the down 20% from the peak earlier in the year, and then rallied back a little bit. But not only the market downturn, but sentiment has been. And this is a chart of consumer sentiment from the University of Michigan. And as you can see, it is below COVID, or it's at COVID lows, and it's even below the lows of global financial crisis. And unlike the markets, I checked this just today, consumer sentiment is still pretty significantly down pretty much at the same level. So far, we haven't seen an improvement yet in consumer sentiment, but given just the events of the last couple of days, the expectation would be sentiment would start to improve going forward. But again, just a couple of weeks ago, here are the first couple of charts I would have started off as to where we are, but how quickly things change. Not only sentiment, but uncertainty. That's probably the key term of not only the current period, but the last several months and even several quarters, of just the amount of uncertainty in the markets continues to be at all-time high. This is an index that I tracked. It is an index of economic policy uncertainty. This chart, as you can see, goes back to 1986, and I put a red line so you can see it clearly, a red line across where the most current reading is. And again, I checked this one just yesterday, and uncertainty is still at these current levels. So while we have seen significant improvement, I'll say we backed away from the abyss of worst case scenarios of economic uncertainty, and in particular trade tensions and trade wars, but uncertainty still reigns supreme. I think if you look at this chart, is reflective of that. despite the significant improvement we've seen in the last couple of days.
Well,
Not only,
Steve,
yeah,
I told you I interrupt you a lot, but
absolutely,
even going back to consumer sentiment, the interesting thing there is that
yeah, I'll jump
forward
back.
returns are often best when consumer sentiment is at its lowest. So I saw a chart that the lowest 10% of sentiment readings forward returns have averaged 14% for the next
100%.
year. So that's often, and we've kind of seen that already, right? When sentiment was hitting its lowest, we've seen a bit of a rally here. So that's not necessarily a bad thing for investors.
No, super important point to bring up. Thanks, Christian. Because yeah, there's a chart that showed in the past a couple of times. I don't have it today, but that shows the lows in consumer sentiment and forward returns, forward 12-month returns on the S&P 500, and the comparison between forward returns when you're kind of putting money to capital to work at peaks in investor sentiment versus troughs. It is night and day, and the average 12-month return on the S&P 500 from investing in troughs and investment sentiment is north of 10%. So, and if you consider this consumer sentiment a low, which based off of the market reaction, whatnot, my guess is that this would be a low point, at least in the near to medium term, a low point in terms of consumer sentiment. It's playing out that way because we've seen with the market doing what it is today, up another 1% today. Since the April 8th low in the S&P 500, the S&P has rallied 18.4%. So that trend just continues to be a poster child for as bad as it can feel sometimes when the rest of the world is in a lull and in a low, and sentiment is at a low. Oftentimes, if you look back at history, it is one of the best times to put money to money to work. Keeping in mind what your risk tolerance and time horizon are. But it goes, when everyone else is selling, that's when you want to be buying. To quote the now retired but soon to be retired great Warren Buffett. But it's a great point to bring up in terms of great points to put capital to work.
And that's a good point. Just
Yeah.
let me chime in from the financial planning perspective. A lot of times in down markets and volatile markets, we'll have clients call and say, hey, should we be doing something different? Well, the portfolios that our clients are in are based on their plan, their situation. So they're made for times like these. If you're in retirement, taking a monthly distribution, if you're a long ways away from retirement, your portfolio is built for your situation. So sometimes it's a hard answer to give when times are uncertain, but your portfolios are built for this.
Another fantastic point. And actually, I think it speaks to, I'll show this because this is another aspect of investor sentiment from just a couple of weeks ago. It's a survey of investors that we follow pretty closely from Bank of America. And as you can see, in April of 2025, the sentiment for the number of people that were at that point in time getting ready to reduce their weight in U.S. equities, which had just been absolute rock stars for the last couple of years, was at an all-time, I guess, low, depending on how you look at it, right? But the number of investors was an all-time high, and people reducing their weight in U.S. equities. To your point, Austin, I think not only portfolios built for specific situations like these, as an aspect of that, as we know, together we work on globally diversified portfolios. So as kind of depressed as sentiment and returns had gotten in U.S. equities, which had been absolute darlings of the last couple of years. I know the number of clients and prospects and advisors coming into the end of the year that were asking me, why in the world do I own any international? Why don't I just own all the Super 7? And as almost the corollary to this chart, if you looked at up until just a couple of days ago, but even still year-to-date returns this year, international, in particular developed international markets, so Europe, UK, et cetera, had outperformed the S&P 500 by about 15%. And you never know when that's going to happen and when sentiment changes, which is why you have exposure to global equities, globally diversified portfolios, because as one thing yings, the other thing yangs, and provides that over time, it's providing that kind of consistent return that our clients alike are seeking in making sure their financial plan is kind of on a more consistent path over a period of time. So it's a fantastic point because you never know, and international continues to be an area that of interest, despite the improvement we see in the U.S. in the last couple of weeks, and we'll talk about this in a little while. International markets continue to be extremely interesting, and I think there's a couple of catalysts there that we'll talk about in terms of unlocking some of the value that have been present in international markets for for decades, if not years. But it's a great point to point that the global diversification of all our portfolios, are there for a reason. But in the spirit of you can't time things, so if those are the first couple of charts that just a couple of weeks ago I would have started off with, and kind of where we've been in the last couple of weeks, everybody may remember, if April 8th was the low in the market, April 9th, which is what this chart shows, literally one headline changed it all. And sentiment had gotten super depressed, concerns around trade wars, concerns around tariffs, which we'll talk about in a second. This chart shows going back to 1950, kind of the unprecedented times we're living in or continue to live in. Going back to 1950, April 9th, which is, in case people don't remember, that was the day where the 90-day, the pause in tariffs was announced from President Trump as things just started to get out of control. If you looked at the markets that morning, so kind of 5:30 a.m. to 6:30 a.m., futures at that day were actually down another 4 or 5% that morning. So it looked like, well, we're only going lower. And then one headline, we're going to have a 90-day pause in tariffs. And that's where the market rallied, north of 10%. I think it closed up 10% that day, but at one point it was up 12% in a single day. In terms of going back to 1950, it was the third best day in history in the market. So, and that was in the days leading up to that, the number of calls and concerns and questions I was getting, I'm sure similar to yourselves, around clients. What should we be doing? What should we be doing? Should we be getting out? What's getting worse? You just, the importance of good financial plan, good discipline, long time horizon, making sure that your money lines up with the time horizon, so that you can take advantage. You don't miss days like April 9th and since then, but continues to show just the historical context by which some of these market moves are happening in real time.
Yeah, and it was so interesting that morning. I actually had an appointment, and Hunter could be my witness on this. I said, the thing is, Trump could come out at any moment and say something that causes the market to rip 8% higher, and that's why you can't sit it out, and you just can't afford to miss these days. So
it well
It was off by
scary,
2%,
but
but he was close. So
yeah, right, exactly. But well said. Even that the day before, I was getting questions from advisors like, should we be de-risking portfolios? What should we be doing? And I'm like, listen, here's the deal with the situation. The risk to the downside at that point in time, the markets were already discounting significant economic kind of deceleration. The risk to the downside is almost less than the risk to the upside, because we're one headline away. Because I'll use the term self-inflicted, right? This is we're entering in these trade negotiation, trade tensions because of what we're doing within the global economy. We have the power to reverse this with one headline, and that's exactly what happened the following day, and all of a sudden up 12%, and you didn't want to miss it, to your point. So it's again just the importance of just not trying to time markets, because you miss days like that. And then in that since April 9th, the rallies only continue. This is since that low of April 8th, April 9th, the market's up. So this is as through 2 days ago. So actually, again, up 18.4% through today, but the market has now basically recovered all of its losses year to date. We're still a little bit below the high in the S&P 500 coming into the end of the year was 61.44. We hit that in late November, early December of 2024. And then year to date, we obviously traded down, but within 2025, we've now recovered essentially all the market losses on the major indices year to date. It's been a pretty impressive rally. And again, just for historical context in terms of where it fits, this is a table of the 9-day winning streaks of the S&P 500. So which covers actually most of the month of May, given it's May 12th, and a belated Happy Mother's Day to any mothers or motherly figures on the call. It is the last 9 days, the 9-day winning streak, and I'll include the last 2 days, the best on record going back to 1928. So in the spirit of just you never know when markets are going to turn. They're constantly reacting to new information. It has been quite the roller coaster is probably the best way to describe it in markets. Even from my perspective, now coming up on 30 years in investment in markets, it's continues to be interesting times, and you just never know what's going to happen. So you got to pay attention into what's potentially coming. But if that's kind of where we have been, and importantly, okay, what from here, where do we go from here? What are the kind of things we're watching? There's probably 3 or 4 areas I'll hit on that I think are most critical, and it really starts with as all the headlines around tariffs and everything happen, keeping an eye on, and this is what, Austin, Christian, myself, and the whole investment team at both firms are watching is what is the condition, what is the state, what is the trajectory of the U.S. economy going forward. This is a chart of something that we follow pretty closely called the Citigroup Economic Surprises Index. And so what a surprise is would be if there is a consensus, if there's an estimate for, let's say, GDP, we think that the GDP report is going to be 1%, and the actual report comes out at 1.5%. We would say there is a 0.5% positive surprise in that reading. Or if it came out, if we were expecting it to be 1% and it came out at just at 0.5%, we would say that's a 0.5% negative surprise. So is the economy outperforming or underperforming what expectations are for it? So it usually tends to be a good guide for what the economic momentum in the United States is, and in other economies as well. And as you can see from this chart, what we've been seeing is there has been I'll say a deceleration in the U.S. economy, because what we're seeing is economic reports are starting to, or have been coming out for a few months now, lower than where expectations were initially expected to come in. Not necessarily a bad thing. If we think about what's going on with interest rates, trying to bring inflation down, other things, you would expect the economy to start to slow as we take a more restrictive policy stance to try to bring inflation things and other things into line. In addition to that, given, if you remember that chart on uncertainty, if you think about the level of uncertainty, like most people, if you're uncertain about what the future looks like, you tend to hold off maybe on spending, you hold off on making investments, whatever it might be. So that same thing for the economy. So given the uncertainty and given policy moves, we're seeing the U.S. economy start to decelerate. The good news, though, is it's from a very high rate. So in terms of the risk of, are we going into recession? We'll talk about that in a little while. We're decelerating from a very high rate. So if people remember 2024, the U.S. economy was growing at a clip of anywhere from 2 to 3 to, in some cases, 4%. For reference, the long-term average real economic growth rate of the United States is around 2%. So if we're growing at 2%, we're kind of in line with average. We're coming down from a rate of, again, 3.5%. So right now we're decelerating towards probably that long-term average. And we'll talk about the most recent GDP print in a second. But that is one thing that we're watching, is this deceleration in economic activity, to see how does that play out going forward, especially in light of some of the most recent developments around an easing of trade tensions and whatnot. But that really is the foundation of everything going forward, whether it be earnings or whatnot, is how is the economy holding up in the face of these new variables, if you will, in terms of economic trend. I mentioned GDP. So people probably saw most recent, or maybe have seen the headlines, our first quarter GDP, gross domestic product, came in at minus 0.3%. So a lot of people, that might have caught some people by surprise of, wait a minute, are we going into recession? Because that means, growth is negative. Are we in a recession? We are not in a recession as of today. And right now, I'd say the probability of going into recession is maybe a little bit more elevated than a couple of quarters ago, but not, I would say, not relatively high. What happened with the GDP print, and this chart does a great job of breaking out how GDP is calculated, and more importantly, what the major contributors are to economic growth in the United States. You can see in the box above the bar chart the kind of different categories that contribute to our economic growth. No surprise, consumption. So just U.S. consumer spending is by far the largest contributor to our economic growth. So 68% of our GDP comes from just you and me and everybody else just buying things, because that tends to drive economic activity. Business fixed investment. So think about companies spending investments to build new infrastructure, buy new things. That contributes about 13%. Government spending contributes about 19%. Housing, residential housing, contributes about 4%. And the important one here is net export. So when we import more than we export, that actually counts against our economic growth, because we're buying things from outside our borders. When we export more than we import, that is a positive for us. We are more of an importing country than we are an exporting country, and so usually our net exports, our trade deficit, if you will, importing more than we export, counts against our GDP by about 4%. What happened in the first quarter of 2025 to create that negative 0.3% contraction in economic growth? Given the uncertainty at that point in time, we still hadn't started trade negotiations. We had announced tariffs from other countries. We had announced tariffs proposed tariffs from the United States. So what happened was, in anticipation of those tariffs being implemented come April, May, there was a mad dash. So like anybody, if there's a sale or prices are going to go up, everybody tends to go out and buy what they need, and sometimes they're not what they need, in order to avoid that price increase. That's exactly what happened in the US economy. So there was a mad dash of companies, consumers, you name it, to buy things that come from overseas that we import ahead of potential tariffs being implemented. And you can see in the red box up above where I've highlighted the contributors to that first quarter GDP print. Down below, you can see the net exports line came in at a minus 4.8%. Now, on average, usually that contributes, that's less than a percent. So because we started to import so much in Q1 ahead of those tariffs, that was a significant headwind to our economic growth in the first quarter. That's not, especially now with the developments and kind of trade tensions easing, not something that we do expect to continue. So that was kind of I'll say a one-off, but that's really what contributed to that negative GDP print in the first quarter, is that reversal, or that surge in imports ahead of potential tariffs. I will say this, in anticipation of, you may start to see some noise around our economic growth in the coming quarters, because the other line that you'll see in the box above this bar chart, see that line, change in private inventories, that contributed positively 2.3% to our economic growth in the first quarter. So if you think about a store buying and storing inventory on the shelves in order to sell to consumers, when we had the mad dash to import things that potentially were going to have a tariff, that created a huge increase in inventories, everything from companies, consumers, the store on the corner, you name it. They increased their inventories. That counts positively towards our economic growth. Now, going forward, now everybody has excess inventories, which is a good thing to a certain extent for consumers. You're not going to have a shortage. But what happens is, when in the coming quarters, because we've built up inventory so much, we're going to start selling out of inventory. When the US economy sells out of inventory, it actually is a headwind to our economic growth, because we're not building new things to replenish that inventory. So stores are just selling things off the shelves instead of ordering more things to replenish their inventory. So going forward, we may start to see in Q2 and Q3, depending on as that inventory is depleted, you may start to see some headlines around weaker than expected economic growth. A lot of that coming forward is going to be just this significant change we've seen in import-export patterns in that Q1 surge of imports that created ahead of the tariff implementation. So that's a big part that I wanted to kind of just drill down into, in terms of, because it can be unsettling when you see negative 0.3%, but there are specific reasons as to why that happened in Q1 and why we may see some noise in the coming quarters. But the underlying trajectory of economic growth in the United States, while decelerating, is still pretty stable. In terms of again, mentioning why there was a big surge in imports in Q1, a lot of it related to potential implementation of tariffs. So I updated this next chart. We'll get into tariffs. That's a big headline nowadays. This chart actually breaks down. I just got this chart today. This chart takes into consideration and breaks down all of the most recent negotiations and deals that have been made on the tariff front on a trade-weighted basis. And that's what these bar charts represent, of each individual tariff that have been put on, whether it be China fentanyl, whether it be aluminum and steel, what have you. But all weights over to the far right of this chart in the far blue box. That, as of today, is best estimates given all the most recent deals, even the most China deal over the weekend, and the UK deal from Friday into the weekend. Right now, we would estimate that there is, on a trade-weighted basis, the tariff rate on US imports is going to be about 14%. Now, the good news is, down significantly from the worst case scenarios. At some point, we were seeing estimates of 35% when you considered all the different tariffs in different countries. So 14% is much better than our worst case scenarios, and I think that is what's been a huge catalyst into improving the market sentiment that we've been seeing and causing the market to rally like it has in the last couple of weeks. I think, but importantly, it's sent more for going forward. I think it's still important to put that 14% in historical context, which is what this chart does. This is a chart of going back to 1820, actually. All the trade-weighted tariffs that the U.S. has had on our imports coming into the country, going back to 1820. And so you can see, pretty much since about 1940, post-World War II, the rate of tariffs on imports, because of free trade, because of trade negotiations over the years, has been coming down consistently. If you look over to the far right of this chart, that red diamond is where that 14% tariff rate most recently comes into play in terms of where it compares to historical. So while 14% is still significantly better than our worst case scenarios, I think what's important and what we're watching going forward is that 14% is still a relatively significant increase in comparison to the last couple of years. In fact, it's the highest rate of tariffs that the U.S. has experienced really since post-World War II, so since about 1942. So that is a significant change in a potentially short amount of time. While better than worst case scenarios, I think for us, the biggest thing that we're watching is, okay, how does that significant change in a short amount of time, how does that impact the economy, businesses, consumer spending, et cetera, earnings going forward because of that increase relative to history? So while the sentiment has been great in the market rally, we will never we'll never complain about market rallies. I think what we constantly talk about is, okay, we still don't know what the impact of even that 14% is going to be in terms of demand for trade, demand for imports, exports, you name it, and how that flows into the overall economy. But I think this chart does a good job of putting that 14% in context. So better than worst case fears, but still a significant increase relative to history.
I think there's a couple components there of the tariffs. The one being, how it flows into whether it's inflation, earnings, that sort of thing. But the other is really just the uncertainty component. And so how does this affect CapEx decisions? I think we'll talk about that later. But there's a lot of difficulties for management of companies when they don't know where their tariff rates are going to be. So those are potentially just short-term issues, but those are all things that we're going to see. That from an inflation standpoint, we had a good CPI print today. We haven't seen much flow into those numbers at this point. We might see a little bit in the May numbers, but
yeah, absolutely. And you hit on a couple important points there, Christian. I think you mentioned the uncertainty, and I think companies at the company level, what we've seen is the number of times that tariffs were mentioned on earnings calls from this first quarter is through the roof relative to history. So it's on the mind of companies, and the uncertainty is potentially causing them to pause in terms of spending plans, et cetera. But I think it's also bleeding into a new trend that we've seen from more than a handful of companies is they're pulling their full year guidance. So usually companies issue guidance around their earnings for that potential calendar year. We've seen Delta Airlines do it. We've seen United Airlines. I think United Airlines gave a different outlook, but a lot of companies are saying, you know what, we don't know what our business impact is going to be from tariffs yet. At that point in time, they didn't even know what the final tariff is going to be, and they didn't know what the impact is going to be to their business. A lot of those components are still present. So you're seeing companies pull their full year guidance because they don't know exactly what the business impact can be. That's only kind of increasing the amount of uncertainty on the part of investors and analysts. Like, okay, I don't have get a sense of what you're going to earn this year, so it's harder for me to make a decision on whether your stock is appropriately valued. So it is adding to that level of uncertainty for sure.
And it's even some uncertainty from the consumer standpoint. A lot of the earnings calls I listen to, they aren't seeing an effect yet on the consumer, but some like Chipotle talked about there being some softness and going out to eat activity. Colgate-Palmolive even talked about people normally buy 2 rolls of toothpaste and they might only be buying 1. They're stacking up, so you're starting to see a little bit of softness, but it's very industry specific at this point, and completely tell how broad that gets.
Yep, I think Walmart mentioned too that they're seeing that they're definitely seeing a more value focused consumer. So to your point on like not as much high discretionary spending. It's more like let's buy what we need for now because we don't know. And it's at certain specifics. It's not across the board, but again, it's something to pay attention to at the margin for sure. And you also mentioned inflation, another one of my favorite topics. So you mentioned the inflation print this morning. So this is a chart of two big measures of inflation. So there's the CPI, Consumer Price Index, and then there's the PCE, which is the Personal Consumption Expenditures Index. Both those measures, the Federal Reserve and investors broadly kind of really pay attention to as a gauge of inflation. This chart shows the 3-month annualized rate of inflation using both core CPI and core PCE. Core just removing the effects of energy and food to make it more stable, because those two things, energy and food, tend to move around a lot. So it kind of gets a better sense of what is the rate of inflation doing. The chart shows, again, the 3-month annualized rate. I like to look at the 3-month annualized rate because it shows the most recent trend in inflation, as opposed to sometimes year over year, you can get a little bit more noise. So this kind of shows what inflation is doing. The red dotted line is actually average hourly earnings for US workers. And I like to track that as well in relation to inflation. And the good news there is you can see the red dotted line is moving, is above the the orange and blue line, which are the inflation measures. That means actually workers are on average getting real wage increases. So wages are increasing faster than inflation, which is good for consumer spending. So that's something that we definitely pay attention to. And that's been a trend really since we started to see kind of labor tightness in the last couple of years. But as you can see, the blue line and the orange line are downward trending. So this chart does not take into consideration this morning's print, which is actually even better. But before that, the annualized rate of inflation, 3-month annualized rate, was about 2.8%, which is still higher than the Fed Reserve target of 2%, which is that black dotted line down the bottom. But the important thing is the trajectory was headed in the right direction. If I included the CPI report from this morning, which we came in at 0.2% on a month-over-month basis for core CPI, that actually number would actually, believe it or not, would drop to 2%. So on a 3-month annualized basis, core CPI is back down to Fed target, which is great news. The challenge in this, and Christian, you and I were talking about this, right? The challenge in this is, okay, what is the Fed supposed to do? That's where we bring in that tariff uncertainty back into it, because while inflation on its own, kind of ex tariffs, has been coming down, historically, tariffs tend to have an inflationary effect on prices, at least for a short period of time, usually 12 to 18 months. There's kind of a perceived price increase. And then as those tariffs, because the tariffs don't increase every year, that impact tends to roll off over 12 to 18 months. But right now, I think the Federal Reserve they know tariffs are being implemented. So they've been kind of on pause, as last week's Federal Reserve meeting indicated. They've been on pause because, like, okay, we're not sure what impact, how much inflationary impact there's going to be from tariffs. So they're just kind of waiting and seeing. Like, the consistent theme of this call, there's a lot of just, we got to see what the impact is. We're not sure yet, which is why, as great as the market rally is, there's still some uncertainty that I think the economy and investors need to work through, that we just kind of pay attention to. But there's a lot of good things happening below the surface of, inflation coming back down towards target, ex tariffs, as well as, like I said, real wage gains on the part of consumers to support consumer spending. So there's a lot of good things going on, despite the level of uncertainty in the coming quarters.
And if you back that CPI chart up to during COVID, you got up to about 9%. So this the whole scale would be different of this chart. So we've come 100%. A long way, but it doesn't change the fact that the Fed is in a very difficult position, and I'm sure there will be challenges ahead for them. But when you think about, the Fed has 2 jobs. One is inflation, and the other is unemployment, or the labor market. And they want to keep unemployment low, and they want to keep inflation right around that 2% target. And so we've had inflation above 2% for quite a while. The trend has been in the right direction. On the flip side, unemployment rates have been historically quite low, but the trend has been going the opposite direction. It's been going up a little bit. It's moderated the last few months. So the Fed is in this tricky position where you could make the case that maybe they should have cut by now. But the tariff variable, they don't know. They can see economic data. They've got access to the best economic data, but they don't know where tariff rates will be a month from now, 2 months from now, and then even how much those tariffs will feed through to inflation. So there's some variables that they don't know, and it's a challenge to think through. Well, we don't want to cut early and inflation run away, and all of a sudden, we're cutting while we're near historically low unemployment rates, and then we let inflation get out of control. I think Powell very much doesn't want to have the legacy of being the Fed chairman that let inflation get out of control.
Yeah, definitely.
But on the flip side, if you wait too long and unemployment keeps ticking up, there's a lot of data historically about how once that unemployment rate starts to accelerate, it's pretty tough to stop it, and even cuts at that point probably can't do much about it. So they're in a tough position, and whether they'll make the right decision, we'll have to see. But that's a big factor in all this as well.
100%. And you actually hit on what I think is probably, if there's one thing or 2 charts to take away from this whole talk, I think the next 2 are it, because you mentioned the dual mandate. We talked about inflation and price stability, but full employment as part of their dual mandate from the Fed. That is probably the biggest thing that, for me anyway, I am watching right now is the state of the labor market, and for a couple of reasons. Well, actually, I apologize, but before I get to unemployment. So this just shows, this is a chart, another thing that we monitor in terms of the health of the consumer and consumer spending. One of the things that we are seeing a little bit is an increase in delinquencies. So this tracks, this is a chart that tracks all loan delinquencies. So think credit cards, think auto loans, think mortgages, et cetera. And what we can see from what's been circled, we have seen a pickup of loans in delinquencies. So that's usually 90 days past due. It tends to be a precursor for consumer spending potentially starting to slow. I would say, so even I can see from this chart, it's now moved above the pre-COVID level and starting to plateau, which is a good sign. I'll say if you dig a little bit deeper into this data, what we're seeing is a majority of those delinquencies are coming from low income consumers. So think households below median income. So households usually below $50,000 in income. That tends to be where the majority of the delinquencies are coming from. But definitely still something we watch to see, does it start to spread out into higher income households, or does it stay kind of contained, if you will? So that is something that on the consumer side that we're watching. And where it relates to kind of the next chart, which is employment related, consumer spending and consumer sentiment. If you think of that consumer sentiment being in the lows right now, employment and do I have a job? Do I feel good about my job? Can I get a job if I lost my job? All that plays into consumer sentiment and consumer spending, which is why I think now the two key charts that I would take away from this isn't related to labor and employment. This is a chart from the Federal Reserve of St. Louis and the Bureau of Labor Statistics that shows the hiring rate in the United States going back to 2002. So the hiring rate is how fast are companies hiring unemployed workers, or how fast are they just not necessarily creating jobs, but hiring new workers. And what you can see is since about 2022, the rate of hiring in the United States has been in decline. It's bottomed out right now around 3.3, 3.4%, which relative to history, other than global financial crisis, tends to be on the lower side of hiring rate. Why this is big for me is if you think about the U.S. economy absorbing workers that are looking for employment, how fast they're hiring tends to be how fast the U.S. economy can absorb new workers and get them employed, so they have income, so they can spend and generate economic growth. So the fact that the U.S. hiring rate has been in decline in and of itself is not a huge issue, other than it's at a relatively low rate. But the flip side of that, and this is the other kind of key chart that is in front of my mind, is are we starting to see layoffs pick up? So this is a chart from the Challenger Gray and Christmas, which does a monthly report on in the private sector, actually in the government sector, how many people are getting laid off from their jobs. And so what you can see, this chart goes back to, this is from January 2022. You can see that we have started to see a pretty significant pickup in the amount of announced job cuts. Whether it's good news or bad news, I'm not sure, but if you were to dig into this increase in job cuts, roughly 85 to 87% of those announced job cuts that you see in this chart are coming from the government sector. So if you think about Elon Musk and the impact in the Department of Government Efficiency, the announced layoffs that they've gone through in the U.S. government, that is where a majority of the layoffs are happening today, and where what's being depicted in this chart. So it's from one area, one specific area of the overall U.S. economy. But why it's on my mind is those workers still need to find new jobs. And so if I go back to this one, right, I'm thinking a U.S. economy whose hiring rate and absorption rate is starting to slow at a time when more people are potentially starting to look for new jobs. That potentially do we start to see the unemployment rate start to tick up? And while a majority of the layoffs so far have been in the government sector, there have been more headlines of private companies starting to lay off workers. So even this morning, we saw a headline from Microsoft laying off 6,000 workers, more middle management positions, but still 6,000 workers laid off that now have to find new jobs, and the economy has to absorb those workers looking for new jobs. So the unemployment rate, to your earlier point, Christian, right? 4.2% today. Relative to history, extremely low. We're still seeing good job opening numbers. We're still seeing good job creation if you look at the non-farm payroll numbers that we get on a monthly basis. But this dynamic in terms of how this plays out going forward, especially when you add in the uncertainty of tariffs and how those impact businesses and how those impact business profits, do we start to see more layoffs and the unemployment rates start to pick up, which then becomes almost a negative feedback loop into consumer sentiment and consumer spending. Right now, we don't see signs of that in consumer activity, but those two charts are probably the front of my mind in terms of watching how those two dynamics play out.
And that could all, the Fed has, in some ways, has been allowed to keep rates where they are because this unemployment rate hasn't ticked up much these last few months. If you see that change, all of a sudden they're going to get a little less fixated on the inflation side and a little bit more fixated on the unemployment side of things.
As we were talking, it's kind of a dynamic, picture, almost a seesaw between full employment and price stability. And I think as one becomes more of a concern, they tilt towards focusing on that and away from the other, and they're constantly balancing those two dual mandate aspects for sure. I think if that's one kind of area for that they're watching closely, I think what has been a positive surprise has been how good company earnings have been. So this is a chart. The bar charts go back to 2022. The light blue bar charts that you see here are the expected earnings growth by quarter of the S&P 500. The dark blue dots that you see above or below each blue bar is what the actual rate of earnings growth has been for the S&P 500. And probably most importantly, if you look over at kind of the middle to the right of this chart, in green, you'll see Q1 of 2025. So we're just coming up on basically being done the first quarter earnings season for 2025. And going into the earnings season, we were expecting to see 6% year-over-year earnings growth for the S&P 500. The good news being, as we come up on completion of that, companies grew earnings roughly 12% in the first quarter of 2025. Now, some of that is potentially related to the GDP chart we showed a little while ago, where you had this, excess ordering, et cetera. So that generated decent earnings for a lot of companies because there was excess demand. But by and large, company earnings is still continually to be extremely strong. Profit margins continue to expand, and earnings growth continues to be well on par in terms of above expectations. So I think going forward, in the spirit of kind of what we're watching going forward, especially as we start to see tariffs become implemented, how does that impact overall business demand? How does it overall impact overall business spending? And then ultimately, how does it impact corporate earnings? Because as Christian, you and I talked about, right, at the end of the day, equity markets are driven by what corporate earnings are doing. Earnings drive equities, full stop. Sentiment can move around, but like at the end of the day, that's what's going to drive equity prices. So we're watching what's the impact of corporate earnings. But you can see for the rest of 2025 and in 2026 right now, earnings are expected to grow anywhere from 6 to 15% when you start to get into 2026. So still expecting very significantly healthy corporate earnings, which so far continue to be above expectations. So that's been welcome news for sure. And as a second derivative of that, or kind of an offshoot of that, what's actually been happening because of the uncertainty, you're starting to actually see negative revisions to earnings expectations. This is a chart that tracks. Think of it as like how expectations for corporate earnings have evolved over the years since, in this case, 2020. And you can see we've kind of been flat lines. That's what that blue line shows, like negative or positive revisions to expectations. So a positive revision would be earnings expectations are increasing. Negative revision would be earnings expectations are getting lower. So what you can see most recently over to the far right, the last couple of months, given all the uncertainty around tariffs, we've actually seen earnings expectations coming down for, in this case, the S&P 500 and broad earnings. Ironically, it's actually probably a good thing because now you actually have a lower hurdle rate for companies to beat earnings, which actually improves sentiment and gives them more kind of runway to grow earnings into the future. So on top of good reported earnings most recently in the first quarter, we kind of see a lower bar for companies to beat earnings, potentially even raise earnings going forward because of the uncertainty. It's actually ironic that it's been actually a good thing in terms of expectations. So it's like how I like to live my life. Just keep expectations low and you'll never be disappointed, right? Same thing with earnings. Like low expectations, you'll always beat earnings. So it's been ironic in terms of how it's impacted there. But I think that's another positive where how earnings grow will be a big focus, but the lower expectations I think are positive for investors overall going forward. Where earnings play into another significant driver of economic growth is capital expenditure. So companies are reporting good earnings or generating good earnings, they're generating good free cash flow. Companies then turn around and use that free cash flow to invest in all kinds of capital expenditures, whether it be building data centers like for artificial intelligence, whatever it might be. this is something that shows kind of the importance that a couple of companies in particular, and I think on this call, I think we've mentioned kind of the concentration of markets right now around the Super Seven. So Amazon, Microsoft, Google, et cetera. This chart shows not only the top four, I think, capital expenditure investors, specifically for artificial intelligence: Amazon, Microsoft, Google, and Meta. Those four companies alone expected to invest roughly 200, almost $300 billion in terms of capital expenditure, which is a significant driver of economic growth. To put that into comparison, the black line, the black bar charts all the way below are what the capital expenditures are expected to be for the entire sectors. So for the entire Microsoft, the entire technology sector is expected to invest around $100 billion in capital expenditure, which is a good amount, but it's dwarfed by those four companies in particular. And not to keep bringing tariffs and uncertainty back into it, why this matters, where capital expenditure is a significant contributor to economic growth, but the Super Seven, in particular, Amazon, Microsoft, Meta, and Google, roughly 50% of their revenues come from outside the United States. So we talk about uncertainty, right? Those businesses are saying, okay, how is tariff implementation potentially going to impact my revenue, because I generate a significant portion of it from outside the United States, NVIDIA, all those. So now that uncertainty, like, okay, I don't know what's going to happen to my revenue, is potentially causing them, or may cause them, to pause in making capital expenditure investments. So again, market rally has been awesome, but we still have some uncertainty to work through to make sure that companies like these four in particular, and the rest of the S&P 500 and US and all the companies in US listed exchanges, continue to invest in capital expenditures. That's really where uncertainty kind of impacts future investments overall. I think kind of the most significant.
And those companies have been pretty clear that they're thinking decades out in terms of the AI spend. They're not thinking quarter by quarter, which on the downside, when everyone's afraid, can be a negative and cause them to sell off more than some other things. But then as things are returning to normalcy, the fact that CapEx is as strong as it is, and you see these companies talking on their earnings calls about robotics and more of like the existential AI thing, is encouraging when animal spirits are returning for investors. So
yeah, totally. To your point, I have yet to see any major headlines of any of these companies pulling back on their planned investments. And now, some aspects of the announced trade negotiations, you're potentially even seeing further opportunities for capital expenditures outside the United States, right? So a couple of headlines today with, I think, Saudi Arabia, where they're potentially making investments but starting to buy chips from NVIDIA. So there are, while tariffs are an uncertainty within the U.S. borders, potentially some of these trade deals unlock significant opportunities to invest and for companies to make investments outside the United States, which benefits the U.S. economy at the end of the day. So again, while it's uncertain, there's definitely positives and uncertainties to both sides of the coin.
And there's clearly been a willingness to carve out exemptions on some of this trade stuff.
Yep.
So that's probably been a little bit of a shift as well, whereas before it was absolute levels of tariffs that are high versus industry specific carve outs.
Most definitely. I'll wrap up. I'm sure people are getting tired of listening to me talk. So I think, if there's a couple of themes probably throughout this conversation, it's definitely uncertainty is still present, although, backing away from the abyss, the worst case scenarios. But if this period, to come full circle into what we said at the beginning, if this period has taught us anything, is just trying to time the market. You just never know what the next headline is going to be in times like this. And I think the next couple of charts bear that out. This chart goes back just to 1997, but I think the point that it makes, this shows the timing of, by calendar year, the best 50 days and the worst 50 days in the S&P 500 that specific calendar day. That specific calendar year. And what you can see is the worst days tend to follow the best days, and vice versa. In fact, there's a little tagline down the bottom. More often than not, the best days in the market tend to come within 2 to 8 days of the worst days in the market. So, and we saw that, right? We saw it in April 8th, April 9th, right? Significant drawdown. Futures were down 5% the morning of April 9th and finishes up 12%. And then you saw, a couple of charts, we showed earlier, that April 9th was the third best day on record since 1950, right? And if you had tried to time that and kind of let emotions take over, you would have missed that. And when you do miss the best days in the market, it can have a significant impact to long-term returns, which is what this chart shows. Going back to the year 2000, this shows the impact if you had missed the 10 best days of each calendar year, what your returns would have been, the difference in returns would have been for that calendar year. So if you look all the way over to the right for 2024 as an example, the market finished up 25% in 2024. If you had missed the 10 best days in 2024, your return would have been 5%. And if you compound that same idea of each calendar year over this entire period for 25 or 24-year period, in compounded wealth, if you had kind of left your money invested through that 25-year period, you would have an average return on the S&P 500 of a little over 15%, 15.1%. If you had missed the 10 best days in each calendar year for that entire period, your return would have been minus 18%. So you're talking about almost north of a 30% swing in compounded wealth over a period of 25 years. So just in the spirit of kind of what this period has showed us of trying to time the market, as opposed to echo Austin's comment at the beginning of like good financial plan, disciplined financial plan, long-term time horizon, having the money that you need short-term in the appropriate risk tolerance, so that you can let your longer-term money work on your behalf and let compound wealth to reach your goals. I think that's been echoed in this roller coaster market environment for sure. So I'm going to stop there, guys. But obviously, anything I missed that's on the minds of both of you, or questions from anybody, happy to keep the conversation going.
Yeah, I appreciate it, Steve. Well, maybe a couple of topics just to hit on that I might have some thoughts on, but I'd love to hear Steve's. But we are getting close to 4 o'clock here, so if you need to drop off, we won't be offended. And two, feel free to throw comments in the chat there, and I can ask Steve those questions as well. But one of the things, thinking about bonds, and that's been one of the, especially earlier on in the year where yields really did come down. Bond returns were looking great. They've drifted up a little bit in the last bit here, but they're still positive on the year. How do you think about, and I guess maybe one other piece is you hear a lot of headlines right now, a lot of fear around bonds, whether it's, are these other countries, is China going to stop buying bonds?
Right.
What's going to happen, and even the US, the government debt levels, and what's that going to do with yields? So maybe, Steve, any thoughts you have just on being a bond investor in this environment, and also maybe separating some of the signal from the noise with some of those bond yield headlines?
Totally, yeah. I'll take the first one around kind of foreign ownership of U.S. Treasuries first, with one side note around I will say fixed income today, bonds today. I think everybody still has investor PTSD, for lack of a better term, from 2022, when it was like, oh my God, my bond portfolio is down 18%. Like, bonds aren't supposed to do that. And what I've been saying repeatedly is like the fixed income market today is 180 degrees, night and day. You could not get more of an opposite end of the spectrum in terms of where the fixed income market is today, because in 2022, the duration of bonds was extremely long because the yields were so low. So if you think about a really poor analogy I use, if you think about somebody who has had or is in need of a knee replacement, a lot of times the doctor says that there's no cartilage left, it's bone on bone, right? And it can be painful. In bonds, when there's no yield, there's really no cushion in that bond to adjust to interest rates. If you have more yield, there's more cushion in the overall bond price to absorb interest rate movements. So in 2021 and 2022, yields were zero because of post-COVID. There was no cushion in bond prices, and so when you had as huge an increase in interest rates as we did, there was no cushion. So bond prices just fell 18%. Fast forward to today, now with yields of anywhere from 3 to 6%, depending on treasuries or even investment grade corporate bonds, that 3 to 6% is a significant cushion to bonds against interest rate increases or decreases, but more on the increase side. You'd have to raise to experience 2022 again with where yields are today. Interest rates would have to go up by more than 10% because of that yield cushion. So think about a total return. So that's important. In addition to that, because there's now yield, the duration of bonds, which is how sensitive an interest rate a bond is to interest rate movements, the duration of bonds has come in quite a bit. So I'd say I keep that in mind in terms of today versus the experience of 21, 22. And then in relation to foreign ownership bonds, I'm going to forward this one. I think is helpful.
While you're going there, just
Yeah.
one other comment on that first point. That really, I think probably a lot of our clients felt the difference between this sell-off and the 2022 one. If you're say you own 50% stock, 50% bonds, in 22 you might have been down 15+%, because bonds and stocks are both down double digits. This year, even at the low, with stocks down 19 or 20%,
2 or 3%.
bonds were up quite a bit. You were down single digits, and so it felt very different, even though the headline numbers on the S&P and stuff were pretty similar.
Totally.
So that's the case for diversification, the case for owning bonds, and the whole point about the coupon is a big factor there as well. And even right now, yields have gone up a lot over the last month or so, since the low, and we're still sitting at what, +2% or so on the year on the bond index. So
absolutely, yep. This is in relation to the question around kind of foreign ownership of bonds. So this is as of 2023, so it's a little dated, but the percentages I think are still very accurate. And so this is a breakdown of the total amount of U.S. debt, which is 34.4 trillion, who the ownership is of who owns U.S. debt. And what you can see is the biggest owner of actually U.S. debt is the U.S. government. So between the Federal Reserve and then pensions, but especially the ownership of government bonds to other agencies, et cetera. So the U.S. government is actually the biggest ownership of U.S. treasuries. In terms of foreign ownership, everybody brings up China. You can see on the lower right-hand corner of this, China owns around 2% of U.S. treasuries. The next up is Japan owns about 3%, and then the UK at 2%, and then a myriad of other countries together in aggregate own about 15%. So about 20% of U.S. treasuries outstanding are owned by foreign countries, but everybody likes to bring up China, and I understand why, but they only own about 2%. So I'd say this, in relation to how the global economy, in particular global interest rates are work, if all of a sudden we woke up one morning and all 20% of the ownership of foreign ownership of U.S. treasuries stopped buying our U.S. treasuries, would interest rates move up? Yes. Would they move a lot? Maybe not a lot, because it's 20%. It wouldn't be a significant increase, especially then when you start to get into individual countries. China, 2% probably wouldn't budge interest rates that much. But alongside that idea of who owns our treasuries, important to remember is it is not in other countries' best interest for our interest rates to move up, especially if it's like through them selling our U.S. treasuries, because at the end of the day, today, the world's interest rates, every other country's interest rates are set off of U.S. treasuries. Today, the U.S. Treasury, the T-bill in particular, is still considered the risk-free asset globally. And so if our interest rates go up, their interest rates are going to go up. By and large, not in lockstep because of some of the country-specific issues, but for the most part, it's not in their best interest to have our interest rates start to go up significantly because of them dumping our treasuries. So I think it's important to remember the economic system, the global economic system, is designed a certain way, really going back to 1942 in the post-World War II and Bretton Woods Agreement. And that's been in place for now 60 or 70 years. Might we start to see a shift in some of the trade dynamics and then other global trade dynamics going forward? Potentially, but I think it happens probably at a glacial pace. So I think I like to put that perspective, like let's talk about who actually owns U.S. treasuries, and China's always the one people ask about, and they own roughly 2%, and it's not in their best interest to dump it to increase our interest rates.
That's helpful. The other thing, just in terms of portfolio positioning, diversification was maybe a dirty word in 2023 and 2024. When the S&P post back-to-back 20+% years, people are saying, well, why own international? Why own bonds? Why own anything other than tech stocks or the Mag 7 or whatever? Yep. And we won't do a victory lap 5 months into the year just yet. But it has been a real reversal in a lot of those trends. And even with the recovery. So, global stocks are up double digits more than U.S. stocks.
Yeah, about 15%. Yep.
Yeah, and some Europe even more so. And then even at, we talked about bonds earlier, but even at the sector level, so technology and consumer discretionary and communications have been really the big winners over the last couple of years. Well, year to date, at least coming into the technology was the second worst performing sector in the S&P, and consumer discretionary was the worst performing. And year to date, industrials are number one, utilities are number two, financials are number three. Which, as a side note, actually, industrials and financials have been two of our top three overweights. Utilities not as much, but so it's been a reversal, and some of that, the question is, will it continue, both from a U.S. versus international standpoint, and from a within the U.S. a sector standpoint. I'm curious, Steve, your thoughts on that, but just wanted to point that out that year to date, the case for diversification has been really, really strong. And that's why we structure portfolios that way.
Yep.
Steve,
I will,
some of your thoughts maybe going forward.
totally on the sectors, totally agree. I think what we're seeing, yes, the Super 7 and communication services and technology have been lights out winners the last 3 to 5 years on the back of artificial intelligence, and I think that momentum definitely continues. But what we are seeing is a broadening out of more participation, especially since this route, both going into the downturn that we saw just a couple of weeks ago, right? Most of the profit taping and the most damage was actually in the Super 7 in technology, semiconductors in particular. Again, remember that 50% of their revenue comes from outside the United States. So when concerns around tariffs, they were taking the brunt of it, which was bringing the whole market down. There was actually a point in time when I looked at it was around April 10th. The S&P was down at that point in time. It was called 12 or 14%. I looked at, just as a proxy for just good dividend yielding companies, a lot of which were industrials, materials, financials. The Dividend Aristocrats Index, which I use as a proxy for dividend yield, was actually up 1.5% year to date. So there's that constant shift. And what we're seeing now, especially with some of the trade deals and the expectation that U.S. manufacturing starts to pick up some momentum because of those trade deals, you're starting to see a broadening out and more participation from some more historical value-oriented sectors of the U.S. economy. You mentioned them, financials, industrials, materials. Those potentially start to benefit from very attractive valuation levels relative to technology, and in particular the Super 7. And that doesn't mean the Super 7 doesn't continue to do well, but it just means a matter of more participation, which is good, a broader participation for the overall U.S. economy in terms of sectors. So couldn't agree more. On the international side, I continue to think international is probably one of the most interesting areas looking forward the next several years, maybe even a couple decades. And it comes back to my comment on Bretton Woods too. The global trade system and the global economy really has been set up around, since 1942, Bretton Woods, New Hampshire. They set up a kind of global system where the U.S. was a large component of that, dollar reserve currency, et cetera. I don't think any of that goes away. But what's happened is Europe and a lot of other parts of the outside of the United States started to rely heavily on just the U.S. as the consumer of the world, and started to rely on that for trade, started to rely on that for a whole bunch of reasons. And I think now, and you can see this in the movement of the dollar, because you've seen a recovery in yields, you've seen a recovery in commodities, and you've seen a recovery in equities. You really haven't seen the dollar move too much. I think the DXY was up like 101, but for the most part, the dollar really hasn't recovered from where it was. And I wouldn't be surprised to see kind of the dollar go sideways, maybe, and trade down a little bit. So if we want to be a manufacturer and export and do more exporting, we want a cheaper currency. So that's one thing to consider. And as a US based investor investing out overseas, when the overseas currencies appreciate, that's good for us as a US based investor in international equity. So that's something to keep into consideration. But in addition to that, and I think Europe in particular, especially post Brexit, but they have kind of relied on the trade relationships that have existed for the last 60 or 70 years. And I think on the back of these renegotiated trade deals, I think I've seen a unification of Europe in particular in the Eurozone in a couple of actions that have been taken, in particular the German debt break rule, which is a really fancy way of saying Germany is now going to issue debt in order to fund investment in their defense sector, but also other areas of the economy. That is a significant change for a country that is petrified of inflation going back to Weimar Republic and post World War I. That is a significant change, and I think what's happening now is other countries on the back of the recent developments are saying, okay, we have to get our house in order. We have to start to invest on our own. We have to start to invest in our own economy. We have to start to make trade deals with other countries on our own. And if you consider the valuations and where they are of international securities relative to the U.S., extremely attractive valuations and potential catalysts for growth. So I think Couple that with a potential slightly declining dollar. That doesn't mean the dollar's going away. That just means in relation to other currencies, the dollar potentially depreciates. That's all makes a really strong case for not only global diversification, but in particular returns being generated from a non-US part of a portfolio.
Yep. And dollar strength has really been a headwind for some of that international investing for a while. So to finally get, and obviously we don't want a dollar that's dropping, significantly, but a slightly weaker dollar compared to some of those foreign currencies has been a positive for international markets. So
absolutely. Yep.
Well, I don't want to keep everyone here all day. There's still plenty more that we could talk about.
There always is. There always is.
That's right. One final chance for people to drop in any questions that they might have. But you can reach Austin or I by email, phone. I especially really, I mean, Austin does too, but I really enjoy talking about these things. This webinar could have been 5 hours and I would have still been excited. So feel free to shoot me any emails, any follow-up questions you have about any of this or topics we didn't cover. I'm actually kind of happy. We did talk about tariffs a little bit today, but I'm happy that that wasn't the major focus, because I think what's really important, and we've been talking about this for a while, is tariffs certainly make a difference in the short term. But you have to look through some of these things and look to the other side. And what really does matter is corporate earnings, which Steve talked about being positive in this first quarter, and the economic picture on the other side of tariffs. So I think that's really key to remain laser focused on those things. And of course, there'll be plenty of headlines between now and then. But
definitely.
But yeah, we really appreciate everybody joining us today. Truly do send us any questions or thoughts that you have after this is over. But thank you all for joining us. Thanks, Steve.
Thank you, everybody, for coming.
Always fun. Look forward to coming back.
Sounds good. Thank you all. Have a good rest of your day.